Okay, hello everyone. Hello, Paul, and welcome to this webinar, to your webinar. How is London? How is the weather in London today?
It's good. The weather in the UK is good today. We'll see how long it
Okay, I
lasts
see
and stuff.
you're on
We'll
short
see.
sleeve, so it must be
That's right. Yeah,
nice and
warming up.
warm outside.
Yeah, it is indeed.
Nice.
Summer has finally turned up.
Awesome. So today
Yeah,
we will learn more about risk management, right?
absolutely, absolutely. We did a session on it a few months ago, and
Yeah.
today we're just going to take it a little bit more, just another level, just to help people understand it and manage it better in their own trading.
Fantastic, fantastic. Look forward to. So I think you can share your screen and you can take over.
Excellent, excellent.
Okay. So I
Thank you,
wish you the
thanks,
best
Theo.
luck.
Cheers. Thank you, Theo. Thank you.
Okay.
Good.
I will keep
Cheers.
sorry, Paul, I will keep my laptop open because the cloud is full. So the webinar will be recorded on my cloud and I'll just put it on mute. Okay.
Absolutely super.
Okay.
Thanks for the heads up. Thank you, Theo. Good afternoon, everybody. Hello, welcome to the next in Admirals webinar series, our price action trading guide, session 45. Here we are, ladies and gentlemen. And what we're going to talk about today is about improving your risk management. Might seem maybe strange if you're a completely new trader to be sort of talking about risk management when we're supposed to be talking about price action. But the reality is that they both go hand in hand together. It doesn't matter how exceptionally good you are at using price action to analyze and trade a market. If you're not able to manage risk first and foremost, well, you're always going to have a few struggles and a few challenges. So it's important that we're able to just make sure that you're able to fully understand it and be able to work out how to employ it in your own particular trading. And today, as I said, we're going to be sort of just going a little bit more in depth on certain elements of it, and it's a theme that will run throughout this entire series. So, for those of you joining us for the first time, remember, here we are. We're Admirals, a Forex and CFD broker with a global presence and local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and giving you the opportunity to engage with markets on both the MT4 and MT5 platform and also the Admirals Supreme Edition. If you have any questions about Admirals, please get in touch with your account representative and they'll be very happy to help guide you. So, what will we talk about today? Well, not unsurprisingly, it's the price action series. So we will always talk a little bit about price action, but what we really want to focus on today is risk management. Why is managing risk so important? Okay, especially for new traders who may just be sort of entering and starting their trading journey. We'll talk about what can we do to help ourselves and what are some maybe additional tactics and techniques we can utilize to improve risk management when we're engaged in intraday trading, okay, when things are happening much faster. And then, as always, we'll have a little switch across and have a little look at the live markets and what's going on there at the moment. So, as always, I appreciate that we have a broad range of people who join us for our sessions, from complete beginners to sort of advanced intermediate traders. You're all very welcome here. There'll all be something for you to take away, okay, to help you just progress on your own trading journey. And as always, as I say, I appreciate we also have a global audience who join us. So wherever you are in the world, you're joining us. It's great to have you here. Myself and the Admirals team, we welcome you here. We hope you're having a good 2023. We hope you're enjoying these interesting markets. And it's great that you're joining us, and we hope you'll be joining us for the rest of the year. For those of you who don't know me, my name's Paul. Traded for many years, traded for clients, traded for funds. Primarily, I focus on FX indices and commodities for my own trading. Tend to be a trend trader for longer term, and then a reversal trader for shorter term intraday trading. So all of this, I'll be utilizing all that my kind of experiences, sort of sharing elements of that with you as we've been going through this entire series. And I think most people have joined us here before, okay. And really the overall series of the kind of Wednesday afternoon webinars is about sort of just looking at all elements of price action, the whole idea being that new traders can sometimes be a little bit overwhelmed, a little bit intimidated, but by actually understanding price action, understanding sort of candlesticks, gives the opportunity to be able to analyze markets and then go on and trade them. And that's what this whole series has been doing, and basically educating you, providing you with insights, showing you ways that you can utilize price action in your own trading. And we've covered a great deal, as you can see there, ladies and gentlemen, and I say it every week, is that, all of these sessions have been recorded. They are all available on the Admirals YouTube channel. So if there's one or two you've missed, or a couple that you think that you could do with, just re-looking at, so taking another look at, you'll find they are all there on the Admirals YouTube channel. And as I say, I always try and mix in an element of the hard skills and the soft skills. The hard skills is what the people love, all right? They're looking for setups, engulfing candles, star formations, pin bars, engulfing candles there, okay, false breakouts, etc. But equally, you have to pick up the soft skills, all right? Soft skills about managing risk, about being prepared, about having checklists, routines, okay, grading your trades, reviewing your trades, etc. Those are some of the soft skills that new traders don't recognize to begin with, okay? They just want to know, where do I buy, Paul? Where do I sell? But actually, the longer you trade, the more you'll realize those soft skills are what will help you develop and evolve into the very best trader that you can be, which is what we want. But today, we're going to talk about improving risk management. We'll get there in a moment. As always, I always like to start with just reinforcing the first 5 steps that we've talked about throughout this series. The whole idea being that it creates routine, okay? It creates habits, and when you're starting trading, that is actually a lot more important than many people realize. So we talked about how whenever you open a chart, whatever it is, Bitcoin, Euro, gold, Apple, whatever, first thing you should be doing is defining levels of support and resistance on a chart. Start at the monthly, down to the weekly, down to the daily. Draw on those levels of support and resistance. In step 2, then you're going to define, is there a trend? Say every week, good trends will leap off the chart at you. The challenge we have is that markets only trend 20 to 30% of the time. Okay, the rest of the time it can be transitioning or consolidating. But what we're interested in is, if there are trends, well, what we're looking for is, in uptrends, we want opportunities to be able to buy, okay, on dips. If there are downtrends, we want opportunity to be able to sell at the end of rallies. And so we want to look to see, how does price react at key support and resistance levels, key significant levels. Those levels might be the levels you've drawn in step 1. They might be things like big round numbers, psychological big numbers, like, Russell at 2000, gold at 2000, or it might be dynamic support and resistance. So things like price bouncing off moving averages. So you'll quite often see price will happily bounce up to 20 to 50 to 200. As I said, we're looking for that. And in particular, step 4, we're looking for price action triggers. All right, we're looking for price action triggers at those levels. Those price action triggers are, as I said, some of the hard skills we've talked about. Pin bars, engulfing candles, key reversal formations, inside bars, star formations, etc. That's the trigger that gives us. But it is also important in step 5, take a step back. Is it part of a bigger chart pattern? Sometimes new traders get so focused, okay, on wanting to trade every engulfing candle that they see on a chart that maybe they lose the understanding of the context. So it's worth just take a step back, see, is it part of a bigger chart pattern, something like a flag pattern, a double top, etc. A, it might be another opportunity for you to place a trade. B, it might be just a warning, okay, that you're placing a trade at the wrong place. So, I always talk about the routine and what we're looking at. You'll hear we focus here. There's an awful lot of FX pairs, the dollar index, and the sort of 28 major and minor crosses, looking at all of the major global indices, all of the major commodities, equities, and crypto. As I said, all of these are available for you to trade on the Admirals platforms. And I appreciate also it seems quite a broad range, and it is to begin with. But as I say every week, what will happen is as you get a little bit of practice, a little bit of experience, you will start to focus in, all right? And you might focus in on 2 to 6 instruments that particularly work for you. And that decision should come from the sort of the data you collect, okay, and the feedback you create as you go through your own trading journey. So, as I said, I always go through a bit of a standard intro because I want people to effectively to just embed certainly the sort of, the kind of routines and behaviors and habits, embed them right from the start for new traders. That was what will actually help you a great deal. But as I said, today we want to talk about improving risk management. That's what we're here for. And as the slide says, lots of people are attracted to trading due to the many opportunities that it provides. And what we find an awful lot of is that a lot of people like to focus on trading intraday markets. However, when you're trading intraday markets, your engagement markets, it's speeded up, okay, due to the sort of intensity operations, which means it's easier to make mistakes if you don't know what you're doing, or if your checklists and routines and habits are in any way sort of weak or incomplete. And the thing is, because things are happening faster, well, it's imperative to be able to keenly manage risk during such fast-paced engagements. And that's what we're going to look at. Today, we'll look at how you can improve managing risk during intraday trading. And now, as I said, a lot of it's focused on intraday trading, but everything that I'll share with you, all of the ideas I'll share with you, they are rock solid in terms of, whatever you trade, okay, regardless of whether you're trading commodities or FX or crypto or equities, etc., and also the timeframes. Even if you are more of a swing trader or a position trader, these sort of elements in terms of improving your risk management, they are absolutely key. Okay, and for those of you who are engaged in intraday trading, well, it just gives you a little bit more for you to able to take away and work with. So, for those of you here joining us, all right, for those of you who have been intraday trading, well, congratulations, ladies and gentlemen. You've made it more than further than sort of 80 to 85% of most would-be traders, because lots of people give up very, very quickly because actually they realize that, it's something you have to work at. It's a skill you have to acquire. And what I tell people is that, it doesn't actually take very much to sort of put yourself into the top 10 to 20% of traders in the world. It doesn't actually take as much as you think. You can achieve that by simple risk management that we've talked about, throughout the whole series and all our other webinars. Namely, if you're, never trading without stop loss, never risking more than a small portion of your account in your trade. If you do that, that will push you into the top 10 to 20% of traders in the world. The challenge you have is basically, you've got to work your way to being into the top 2%. And that's the journey that traders find themselves on. That journey could take 2 weeks, 2 years, 2 decades, depending upon your own individual circumstances. But as I said, if you're here and you're working your way, okay, you're in the top 10, 20%. So you can give yourself a pat on the back, ladies and gentlemen, and you'll be asking, well, Paul, what's the prize? Okay, what's the initial prize? Well, the initial prize is, especially if you are, engaged in intraday trading, is that you're now swimming with the great white sharks. Okay, so you should be prepared. And I can put that kind of analogy up because I have done that myself. I've done dives with great white sharks and stuff, so I know that when you go and do that, you have to be prepared, because if you're not, things could go wrong very, very quickly, ladies and gentlemen. And it's the same when you are trading, okay? And it's the same especially when, if you step down and start to engage in intraday trading, where things start to happen very fast. Well, if you are not totally prepared, things can unravel very, very quickly. And so what we want to be able to do is to make sure you've got a couple of the building blocks in place so that you're able to improve your risk management, so that you're able to engage in markets from a position of strength rather than being on the back foot. But there you go. And I also can add, if you ever find yourself wanting to go swimming with great white sharks, doing a case of, I can heartily recommend it. Okay, it's a great little it's a great little present. It's good to terrify yourself now and then, he says. But anyway, bringing it back more to trading is that when it comes to intraday trading, lots of traders, you'll see, you look on social media and you'll find lots of coverage of so-called boys and girls who are never wrong with their trades, okay, and always right. And the truth of the matter is that's mostly rubbish. Okay, that is mostly rubbish. As an intraday trader, you will have slumps in performance, right? You will have streaks of where you might have 2, 3, 4, 5, 6, 7 losing trades on the trot, because things are happening fast. There is feedback. Markets can turn very, very quickly. And so it's about actually how you manage those slumps, right? That will actually help determine your success as an intraday trader, but also as a trader generally. right? And as that Pogo cartoon says, we have met the enemy, and he is us. Very often, I see traders do more damage to themselves than anything the market does, because they're sort of emotionally trading, all right, whether it be revenge trading or whether it be fueled by greed or fear or hope, etc. And a lot of that can be managed by improved risk management, okay, as a starting point. That doesn't mean you won't want to work on improving your trading skills, but if you just have to ensure that you are managing risk correctly, and if you're doing it there in terms of intraday trading, you'll be doing it across all of your trading, and that's what we want to see. If you want some specific help, if you want some specific, sort of further depth, all right, in terms of understanding, why intraday risk management key and how it can be helped by creating things like checklists, processes, and SOPs, standard operating procedures. There's a great book you can read. I always suggest it to all traders to read, called The Checklist Manifesto. It's actually a book from a Harvard-educated surgeon, and about actually how they had to use checklists to effectively help them perform better in operating theatres, where, of course, in an operating theatre, if things go wrong, they can go wrong very quickly, and they can go wrong very, very badly. And so they found that having things like checklists, process, SOPs helped them a great deal. And where they found that from is that they actually learned that from aviation, and in particular military aviation, which is probably one of the reasons why I am so keenly focused on it, and also why it's become one of my own skills. Namely, that checklists, checklists came out of, as I said, military aviation, and in particular, what they call like wide body, okay, multi-engine aviation. Once pilots in the 30s and 40s, once they moved from having one engine to manage and having 2, 3, 4, they found that the instances of mistakes happened, okay, the crashes happened because it was too much. People became overwhelmed and stuff, and they made poor decisions. And by having checklists, that is basically what enabled them to manage that, to make sure they do the right thing so that they can have the safe conduct of flight. And that's why I tell traders to focus on that. The next time you fly, watch what the pilots do. It doesn't matter if that pilot, whether it's his first day on the job or it's his last day after 40 years of flying, he will still do, a pre-flight checklist. He will have a takeoff checklist. He will have a mid-flight checklist. He will have a pre-landing checklist. He'll have a post-landing checklist. They use them because they work. And that's what I always suggest for traders, especially intraday traders, having simple checklists. It helps you because things can change very, very fast, and being able to just follow just a simple checklist can make a huge, huge difference to you in terms of your ability to perform consistently day in, day out. Okay, it works, ladies and gentlemen. All right, that's why I share it with you. It works, so take it on board. Okay, and I saw it firsthand from my own days as well. All right, so I can talk with some strength about that. So, we talked a little bit about routines before, but we want to, you'll hear me constantly hammering it home because it's important. Right, because it is what will start to differentiate those traders who start to move from being in the top 20% to top 10 to top 5 to top 2 as part of their journey. Having a simple trading plan, is important, especially in intraday trading. And we have done bits on trading plans in the past, and I'll do a specific one in the future. I'll do just a very, very clear, checked out one. But as we said, just have simple routines. Make sure you identify those kind of significant levels. Wait to see how price triggers at those levels. How does price perform? Make sure you trade on the break of the candle. All right. New traders, they see a candle forming, they think it's a pin bar forming, they think they can jump in front before the candle has completed. Rarely goes well. Wait for the candle to complete, then trade on the break of a candle if you're a new trader. Always ensure you have a stop loss, normally the other side of the candlestick. Risk no more than 1% per trade, and we'll talk more about that in a couple of slides. And have a good target, you're either targeting, 2 to 1, all right, or the next significant level that price might make to. And rinse and repeat there. That means that you do this, you keep good records, you start to identify which are your good setups, okay, which are your sloppy impulsive ones. You cut out the sloppy impulsive ones, or you minimize them, and you look to do as many of your good trades. And as I said, as you trade longer and deeper, you'll accumulate fabulous data from your own trading, and that data is an absolute goldmine. And you'll start to see the nuggets of what is your particular way. You'll be able to work from that data and refine and hone your sessions. And that's why I talk about it so much, and why I try to impress it upon you traders that this is where you want to be and what you want to be focusing upon. And before we kick in, all right, we're starting to talk about managing risk during intraday trading, and what I find is, if you just set yourself some rules and expectations, okay, set yourself some rules and expectations, almost even before you open your screens, okay, before you even open a chart. Risk management is absolutely key. Okay, honor it, and we'll talk more about that in a couple of slides time. It is absolutely key. Honor it, especially during intraday trading. Know what news is coming out for that session. That in its own way is a form of risk management, okay, in terms of understanding what is the news coming out for that session, okay, what have you got on here today. So when I'm doing this session here tomorrow, we have the US CPI numbers in the afternoon. That will be, what the whole world will be looking at that and wanting to be focused on that. We want to understand when that news is coming out, whether it's going to have a huge impact, all right? I say, for most people, it's better for you to conduct your analysis before you start trading. Don't be trying to do your analysis as you're trading, whether you do it the evening before or whether you just ring fence some time to do your analysis before you start to engage with markets. These are things like, it's managing risk, it's good routines. Resist the temptation to trade out of session. So let's just say that you like to trade FX pairs. Let's say maybe, if you're here, let's say in Western Europe, let's say you like to trade the euro against the sterling. That's absolutely fine. If you're trading it, if you're based in Western Europe and you're trading it on Western Europe times when it's at its most active, which is, early morning London session time, trying to intraday trade the euro sterling at midnight UK time, but in the middle of the Pacific time, is probably not a smart move, okay, because the majority of traders in that who trade euro sterling, they are happily tucked up in their beds, all right? So just resist the temptation to trade certain instruments out of their main sessions. Sounds a bit simplistic, but I see it and hear it happens all the time. Just ensure you have a good internet connection. We take for granted these days that we will always have a good internet connection, but that's not always the case. Especially if you are, traveling as you trade, or if on the move, etc. Just even between meetings or what have you. Just ensure you have a good internet connection. All right, this it's a simple element of managing risk. And one of the key things is ensure you're rested and prepared for the session, especially if you're going to intraday trade. Okay, if you've been up all night because you've been out partying, or you've been, arguing with your partner, etc., and you've only had a few hours sleep, the likelihood is that you're probably not going to operate at your best for that particular session. So ensure you're rested, ensure you're prepared for the session ahead. You owe it to yourself. Okay, you owe it to yourself. This is trading. This is a performance activity, and so you owe it to yourself to be in the best place you possibly can be when you sit down to take trade. And part of that is about managing the risk, making sure you're doing the right things day after day, because these are the key things. These are, as I said, these are the elements that start to move you on that journey from top 20% to top 2%. So taking that kind of one step further in terms of how can we improve our overall risk management, one of the things that I get traders to do is effectively start to plan your week out. Okay, not only start to plan your week out, so know which sessions you are able to trade. Maybe you've got other commitments, okay, maybe you've got a job, maybe you're running businesses, maybe you've got children, maybe you've got parents to care for. We all have very interesting and busy lives, and so at the start of the week, plan out when the big major news is coming. Okay, just do that. But what you can also do, and what I try to encourage traders to do, is to score yourself. Score yourself on certain performance criteria as the week goes down. So let's bring up the old drawing tool here. So, you can, here we go. You can just basically, maybe what we want to do, let's maybe make this a bit different color. We can, score yourself, okay, on how you did your plan and your prep for the session. What was your trade selection like? How were you in terms of managing the trade once it was in? Were you calm? Were you collected? Did you follow your plan, or were you emotional? Were you skittish? Okay. What were your exits like? Did you exit in accordance with your plan, or were you basically just mashing the keys? What was your mental state like? Okay. What was your were you feeling clear? Were you feeling calm? Were you connected? Or were you anxious? Were you disturbed? What was your physical state like? Okay. Had you been out for a bit of a walk? Had you done a little bit of exercise? Had you sort of got the blood pumping around you? Were you in a good place? What was your evaluation? And what I mean by that is how did you debrief after each of your trading sessions? Did you do good debriefs? Did you basically identify what your learning points were? What was your overall performance like? How was that? Okay. What was your performance in terms of units of R or percentage? But also, what was the fun factor? Now, this is a fine line for this, ladies and gentlemen, because it might come as a surprise to you that actually good trading actually becomes quite boring. All right, you're following your processes, you're doing the right things day in, day out, and it actually can be a little bit boring. Good trading is kind of boring. And sometimes what that means is that invariably people crave variety. Okay, they crave variety. They want fun. Okay, they want excitement. But in trading, that fun and excitement can very often come at the expense of good trading. So people take trades out of boredom, or they're just they're a bit dull, they're exciting, they're feeling a little bit antsy, they want a bit of excitement, they want a bit of movement. And so they start taking trades off plan. And that rarely ends well, ladies and gentlemen. So you have to manage that. And one of the ways you can manage that is to have a fun factor, okay? And this means that you can organize other things outside of trading, okay? Outside of trading. So that could be meeting up with friends, that could be meeting up with a partner, that could be having lunch with friends, whatever. Doing something that's fun. Maybe it's going to the gym, maybe it is just meeting a friend for a drink, maybe it's spoiling somebody, maybe it's volunteering, okay, and helping worthy causes. Have some of those elements booked into each of your day to stop you from getting bored and needing variety in your trading, right? As I said, when you need variety in your trading, it rarely ends well. And then give yourself a daily process score, okay? Give yourself a daily process score and see how you've been doing and see how you're doing on the weeks. And the thing is, I guarantee you do this for maybe 3 months or so, and you'll be interested to see sorts of patterns emerge in the way you conduct yourself as a trader. In the same way that as traders, we are looking for, let's say, trends in charts, trends in instruments, you will also start to see trends in yourself. You'll see trends. There might be particular weeks of the month that you operate better. There might be weeks of the month you don't. There might be particular days of the week that you sort of tend to operate and trade better. For me, I tend to operate best on sort of Tuesday and Thursdays, followed by Wednesdays, followed by Mondays, followed by Fridays. Okay, and I know that because over years and years of keeping data and actually understanding my performance, I've started to see that trend within myself. So by keeping this data, you start to help yourself manage risk. Okay, this is almost at the kind of the holistic level, or the overall level, before we even get into any technical details. This is it's all part of managing yourself. All right, managing yourself, managing risk, managing money, managing markets, managing your method. All of it plays its part, and the longer you trade, the more you'll go on to realize this, ladies and gentlemen. So Darshan asks, Paul, are Mondays too manic for you, or you like taking long weekends? So there's a little bit of both there. Darshan. So I tend to effectively, what I find is that I do quite a bit of my trading analysis work at the weekends. So for things like, certainly for like the weekly charts, I love weekly charts, and I do that analysis at the weekends. All right. And what I find is that sometimes I find Mondays can be, how can I put it? It can be a mixed bag. Okay, there are some Mondays which are absolutely fabulous. There are other Mondays where it's scratch your case. Maybe something's happened at the weekend, or there's lots of orders waiting to come in. So those markets can be volatile. They're not terribly clean. And I just basically found, that just didn't tend to suit me. It was basically, I found that Monday mornings, I just found that they could be, as I said, it could be a very, very much a mixed bag for myself. And because I work at the weekends, when I used to work for a fund, I actually used to start trading Sunday night. So I might trade Sunday night UK time when the market's open in the Pacific, and I might be trading till sort of maybe 1, 2 o'clock in the morning. And so I would have a later start on a Monday itself because of that. So, but yeah, as I said, if you keep the data, you start to keep the data, you start to get an insight into the trends within you. And ideally what you'll find, there are windows in the day, there are windows in the week, there are windows in the month, there are windows in the quarter, there are windows in the year where you will be operating at your best. And it's for it's in your best interest to keep the data so you're able to do that. Okay. And, that's, a lot of people said it sounds like a little bit boring, but it's that work that makes you great. Okay, it is that work that makes you a great trader. But good question, Darshan. Thank you very much. So here we go. In terms of improving your risk management, here's a couple of simple rules that we can start to talk about and take on board. The first one, especially for intraday trading, but I'd also suggest, if you're swing trading through the week, is that you have 3 losses on the trot, then you knock it off, and that's and that is basically just stop. So in my misspent youth, as an air defender, once you're into into air combat, it's very intense. If there's a problem, anybody can just call knock it off, and then just everybody goes wings level and stops, until they've sorted that problem out. When it comes to trading, intraday trading, if you've taken 1, 2, 3 losses on the trot, well, the reality is that you are out of tune with the market, not the market out of tune with you. What I sometimes see is that new traders, they'll take 3 losses on the trot and they'll say, "Do you know what, Paul? I'm going to make this money back. I'm gonna trade my way out of this." There's a kind of a bit of an ego. You want to beat their chest and take it on board. But the thing is that what tends to happen is that if you are out of tune with the market, well, what happens is that you are opening the door for effectively revenge trading and to just have a little bit of a day that spirals away from you. So when it comes to your risk management, if you're an intraday trader, 3 losses on the trot, just knock it off. Right, knock it off. You're out of tune with the market. Sit down, go through your trades, work out, what happened. All right, what was going on? What was your review? Okay, maybe you were out late last night. Maybe you didn't sleep that well. Okay, maybe your analysis was off because you thought today would be a trending day, and in fact it's a range bound day, or you thought it'd be a long day. It's a short day. Sit down, do the work, review it, because it'll help you. It'll help you get better day by day. But there you go. Rule number 1: 3 losses on the trot, knock it off. Rule number 2, and this is I find this is particularly for FX trading, but I would suggest that is actually it is valid across all sort of trading styles. Rule number 2 is, if you've not made money in the morning, then the likelihood is you are unlikely to make it in the afternoon. Now for me here in the UK, Western Europe, operating, trading FX, the likelihood is if you've not made it in the morning, you're unlikely to make it in the afternoon. The reason being is there's 2 reasons. There's a kind of almost like there's a markets variation, namely that for me here in the afternoon, we have the American markets come in. So priorities have changed. People are focusing on different instruments, different markings, but also the Americans can be coming in, and sometimes those markets, that means that market can be volatile, or it can mean it can reverse, etc. So for an FX trader, for myself, I've just learned over the years, make your money in the morning. If you haven't, you are unlikely to make it back in the afternoon. So there is the market side of it, but there is also a behavioral side of it, in terms of how you behave as a trader. And what we tend to find, especially for intraday traders, is that, of course, this is a performance environment, so you're expected to perform at your best. The reality is human beings, they will tend to operate for about 45 minutes really, really well, and then you need a break. If you've done 3 or 4 hours in the morning of trying to trade and it's not been great, and then you're trying to do 3 or 4 hours in the afternoon as well, regardless of how fit or how mentally strong you consider yourself you are, you will be you'll be hitting levels of decision fatigue very, very fast. And once you hit those levels, well, then the quality of your decisions tends to degrade very, very quickly. So you start making scrappy trades, okay? You start making trades that just are off plan. And you're looking at that. And what happens is that, you've made a scrappy trade. The likelihood is that you are then more likely to trigger yourself into emotional trading. So which could just lead to, once again, to a revenge spiral. So, as I said, if you've not made your money in the morning, you are unlikely to make it back in the afternoon. That's just a rule of thumb. So, but if you insist on trading for whatever reason, maybe there's news or you have a plan, my suggestion is you scale down. Okay, scale down in terms of your trading size. It's what will help you. Rule number three. Rule number three is know your numbers. Okay, know your numbers. And what I mean by that is know your position sizing for the day, the week, the month, etc. Now, in earlier risk management sessions, we talked about basically, you should never trade without stop loss, never risk more than a small portion of your account at a trade, and then you have to understand position sizing to be able to know how much you're likely to risk on each individual trade. When you're doing faster trading, intraday trading, what I suggest is what they call static position sizing. So you only amend it at the end of the week or the month, not trade by trade. And the reason for that is because things can happen fast, things can change fast. Your P&L can swing about left and right if you've got a few positions open. And so the opportunity to make a mistake when you're trying to do dynamic position sizing increases. So remove that opportunity to make yourself mistakes. Just stick to static position sizing, okay, on an intraday basis. What does that mean? Well, that can mean it should always be just 1 hour you risk, but let's say the capital you risk, that should stay static for the week. So let's say you are on your trade, you're risking $100. Well, that's what you risk for all of that week for each one of those trades is $100. Okay, if that is, let's just say that's 1% of your overall capital. Okay, that is basically what you do. You have a static. You're not trying to work out 1% of your account on every single trade, because if you've got 2, 3, 4 trades a day, that could be swinging quite about. It just takes brain power, which means you're just going to speed towards that decision fatigue point. So basically, keep it static, and to help you, you can create a position sizing matrix. Now, we are very, very fortunate these days that there is fabulous technology out there that can do a lot of your position sizing for you, and that is absolutely fabulous. But I think also maybe sometimes creating your own position sizing matrix is not a bad little tool in terms of understanding what you're risking and in terms of understanding your own business. If you are completely new and just trying to understand risk management, well, this is about learning and understanding position sizing, okay? And your position sizing is really your trade risk divided by your capital risk. Your trade risk is the number of points, the number of pips, okay, the number of handles between your entry and where your exit is, your stop loss. All right, and understanding that divided by your capital risk. And your capital risk, as a rule of thumb, although we're going to talk about that in a moment, is normally 1% of your overall capital, but we will change that in a moment. But as a starting point, that's what we look at. And basically by doing that, working out that equation of trade risk and your capital risk, that's what gives you your position size. What are you trading per pip, per point, okay, per tick? Understanding that, okay, and that is a crucial element for people to understand. And if you're struggling with that, there is a really good page on the Admirals website you can look at. I think I might have a link on the next one, but also there are videos on the Admirals YouTube channel which will explain that better to you as well. And part of that is also, as I said, is not only with position sizing, but understanding the margin requirements. Okay, understanding margin requirements so that you avoid the opportunity for such things as margin calls if you don't have enough capital in your account to cover your positions. Once again, as I said, there is a fabulous page on the Admiral website that I would commend that you all go to utilize. If you haven't seen it before, you can utilize that. As I said, there is great tech out there that you can use with position sizing, but it's not a bad thing to basically to understand it yourself. So I have very, very simple position sizing matrix, okay, that make it kind of easy for me to work out what my position size is during busy trading sessions if I'm going to be utilizing static positions and maybe even static stop losses. And what I mean by that is just having an arbitrary number that I utilize on one or two of my intraday trading tactics. It doesn't take very long to do. It's quite simple, as to understand. But actually, what it does do is it forces you to sort of just embrace the numbers, understand your numbers, and if things do go wrong, because you understand your numbers better, you're more likely to pick up and understand if there's been a problem. If you've position size wrong, okay, if you've had a bit of a fat finger issue, and you've instead of 2 micro lots, you've put on 2 full lots, okay, etc. All these things all of these things you want to be aware of, as quickly as possible. That happens. You're a human. Yeah, you are a human being. So the question was there, why am I using the term the magic number? That's just my own. There's nothing super secret or special about that. That is just my number there, just to understand what 2% of my account looks like, okay, or 1%. That is just so I know in my head what is actually being risked, okay, and then I can break it down based upon the sort of the number of pips. So that I have a very, very quick heads up of what my position size is likely to be, and I can print that off at the start of a week, write on it, draw it, understand it as I have static position sizing during my week. But good catch there, good watch, nice touch. As I said, they're not very hard to create position sizing matrix. Not very hard at all right? And you can just do it, especially for FX, okay, but also for indices, whatever you particularly wish to trade, and you can, as I said, even with the tech that is available, just by having it just gives you a little bit of a quicker understanding of what's this like. So Darshan said, I like this chart. I've never implanted anything like this. Great tip. Yeah, it is. It's simple to, it doesn't take very long to do. I've no doubt that people's skills, Excel skills, might well be far better than mine. You don't need to be an Excel superhero. Just simple, just be able to do it, develop, and just have it there with you, just to basically, maybe it's a sanity check, maybe it's a safety check, maybe it just ensures that you're just doing the right things, okay, in your process to make sure that you are reducing the risk of things like fat finger. You're putting in your 20 pip stop list rather than a 200 pip stop list, or you're putting in, as I said, you're putting in 2 micro lots rather than 2 full lots. So anything like that can help reduce the opportunity of you making fat finger mistakes, okay? It shows to me that you're in control of your business, all right? That you're on top of your business, you understand it. I know that people want to sort of focus on, exciting trade setups, and all people always will be. But as I said, this is the business of trading. This is where we start to sort the wheat from the chaff. This is where we start to see the people transitioning and moving towards, as I said, from being in the top 20%, working towards getting themselves into the top 2%. Thanks for the feedback, Darshan. And rule number 4 for you, okay? Rule number 4, less is more, okay? And when it comes to intraday trading, what I normally suggest is that you risk less than you think you should. Once again, okay, things can change very fast. If you've got 2-3 trades, on the trot, and you're risking, 1% or more, I see people reading 2%, 3%. It's very possible for you to have 3 losing trades on the trot, okay, and that can chip away at your self-belief and confidence. So what I generally have for myself is that, I generally look for about, 0.25% per trade as for my position sizing in terms of my capital risk, and then I will have a max of 2% per day, okay, and that will have, that number rarely, if ever, I can't remember the last time that kind of number got hit, because I'm managing risk, okay, so well, right? It's not about being a superhero. It's not about finding the single best trade, okay? You're not going to become a trading legend in one trade, okay? It's about doing the right things session after session, day after day. These are the things that kind of help you reinforce doing the good things. Rule number 5 is debrief, debrief, debrief. Okay. Once again, for my youth in the Air Force as an air defender, after flying missions, you will spend a lot of time debriefing and taking every last little bit of training value out of those sessions. And good traders do the same. Make sure that when you get to close down your shop at the end of the day, that all of your post-trade records are complete, and then debrief. Okay, keep good records and review them. That, for most private traders, that is the one thing that will accelerate your trading faster than anything else. Keeping good records, going through them, working out, what did I do right? What did I do wrong? What would I do better next time? And utilizing that data to help make yourself a better plan to be a better trader week after week, month after month, quarter after quarter, because that's actually what we're looking at, just working towards that day after day after day. It is, as I said, the only way to really get better as a trader is to do good debriefs. And if you have a trading buddy, well, if you don't, find one. They're all out there. Get yourself a trading buddy and actually just basically debrief your trades to each other. You can do it. You've got great technology available. Do that. The actual fact of having to stand up or just present your trades to your trading buddy and talk about that can sometimes be a bit hard, but I assure you is a really worthwhile endeavor as a trader. So there you go, Leighton. We overran a little bit, but but there's lots there I wanted to sort of just help, sort of work with and sort of share with you. As it said, intraday trading is a popular endeavor with traders, all right, due to its pace and its opportunities. However, as everything gets speeded up, it allows the opportunity to make mistakes. Hence why it becomes imperative to ensure as a trader that you are managing risk and you are managing it accordingly. And that starts in many ways from before you even switch your computer on. All right, managing the risk within you. Okay, if you had a bad night's sleep, you've had been up all night arguing with your partner, right? You've not eaten well, or you've not exercised for a couple of days, all right, all of these things. Okay, in many ways you're managing yourself, but that's part of actually managing your risk, allowing you the opportunity to perform at your very, very best when you need to. And what can help is to have processes and checklists in place to help you with your endeavors. If you haven't read that book, The Checklist Manifesto, it's a great book, fascinating book to read, and it will help just get clear in your mind why you need checklists and how they can help you in your trading. And as I said, to begin with, if you're going to do intraday trading, ensure you're just risking very small amounts until you're comfortable trading lower time frames. Very often, traders launch themselves into trying to trade, 1 minute and 5 minute chats, all right, because actually they think that is, that's where all the action is. But the reality is, everything's happening faster. And so if you don't have the routines, the habits, the behaviors, and the experience and skills to operate at that level of intensity, you are just opening yourself up, okay, to making mistakes. And that is just bad risk management. So I'm not saying you can't do it, but what I'm saying is that the time and effort you put in up front to prepare for it will pay dividends for you on your trading journey. So, ladies and gentlemen, just before we end up for today, just a little note that actually I am going to be back on Friday of this week. Okay, that's going to be our next session. So in a couple of days' time. So hopefully you'll join us for the next session 46. And what I'm going to talk about is going to be part 2 about actually how to trade price action on gold. So I always try and do a little bit of hard skills, a little bit of soft skills. Okay, so there's always plenty to learn, plenty to keep to take on board and stuff. Okay, so Darshan said, I'd love for us to look at the cable chart. We can, we'll overrun. We've got a little minute, but that's what we're going to be doing on Friday, London, 2 p.m. time. Bit of recap, part 1. Talk about why gold's popular and look at price action on gold. Okay, so join us there for this Friday, London, 2 p.m. time for that session. If you want, contact us, you can do. You can see the contact details there. You'll probably get a feedback form after this session. Really appreciate if you just took 30 seconds just to fill it out. We're always keen to get feedback and to see how we can particularly help you. So because Darshan asked nicely, I'm going to do 60 seconds on the pound against the dollar. All right, so we'll do that just to finish as we're overrunning a little bit of time, but just bear with us. We'll just switch across to the chart. Okay. Jay says, great call today, man. I think you're very welcome. Teresa says, thanks for this valuable information. You're very welcome, Teresa. I'm glad you've really enjoyed it. So here we go. Just a little bit of time I have got here. Just because Darshan asked nicely, there you go. Well, we're always happy to help. Here is my profile on British pound, okay? And it was a great trade this morning, an intraday trading. But let's have a little look here. I've got pound against US dollar. Let's just start up. Now, what we can see here is monthly chart, okay? Big round number. We put in a rejection of that, didn't we? We closed beneath the 130. We closed beneath the monthly 50, okay? And this month we can see we've drifted away from that just a little bit as well. Perhaps no surprise there, a bit of a rejection candle off those big particular numbers. A lot of that is just element of sterling weakness after the CPI numbers, okay, were a little bit weaker, and also a little bit of dollar strength that's kind of come back into that market. If we go down to the weekly chart, we can see a bit of a twin towers. That's what gave us that monthly rejection candle. And if we look at the last week was, we pushed down, but we've rejected a little bit at the moment. We're only the second week. We're into Wednesday, okay. Here we go. Just let me just see here. The screen share should be up there. I'm hoping it says that William says he can't see the screen. I'm hoping everybody else can see it there. It should be up there. Should be there for everyone to see. You might just want to check yourself there, William. So yep, Dash says visible. Okay, good. So that is, I personally think we're getting a little bit squeezed there. We've got, here we go, the weekly chart has the 20-period moving average sloping up, the 200 going sideways. We've got the big round number 130 above it. I personally think we're probably getting a little bit squeezed there. And a lot of that could be happening because these next few weeks, markets tend to get a little bit quiet, okay? Everyone's going away on holiday of one sort or another. And so markets tend to kind of squeeze in a little bit before they get ready to blow out in September. William says he can see it now. Raquel says that's fabulous and great. You can see it there. Okay, I appreciate. Sometimes the tech isn't perfect, but it does give us great opportunities like this. Daily chart. So daily chart, we topped out there nicely. That's what I call a domino candle. All right, it was a bearish engulfing candle. We dropped back beneath 130. Back towards the daily 50. I thought we have put a little bit of a swing in there, okay, at the 50, but I'm interested to see that, we have the 20 period coming up, the 50 coming up there, price just kind of going a little bit sideways. My own view on this is Wednesday afternoon. Tomorrow we have CPI data in the US. Friday morning we have GDP data in the UK. My own view is I suspect that, for the next, just under 24 hours, price will probably just pivot around a little bit around that kind of 127.70 area until we get that data out, okay, on Thursday and Friday. That's what my own view would be on that, okay. Let's just clear this down. Let's go here, 4-hour chart. So 4-hour chart, I would say, has probably got a little bit of a bearish bias. You can see that 4-hour 50-period moving average has been moving kind of nicely, but I would look at that way, my view here, just looking at that, might have a little bit of a bearish bias, but it's just tightening up there, right? It's just tightening up a little bit there. Just, oops, that's poor drawing on my part, but I'm hoping you get the gist of it. As I said, you can see the price action's getting smaller. It's getting wrapped up in its moving averages. It's coiling up before it gets ready to make a move. And I suspect any move will come from that CPI data tomorrow because it affects the dollar. And then we'll have GDP data on Friday. Okay, so it's going to be that Thursday afternoon, Friday morning is going to be a major impact on the pound against US dollar. This is the 30-minute chart here. This morning, my trade this morning was basically, as price had pushed out to the previous day's high, put in a very nice bearish engulfing, bearish pin bar, okay, key reversal, and the short was back in towards the 50 there. So that was the move we had there this morning. The same way we had a really nice kind of double bottom move up there yesterday afternoon. So as I said, it's interesting, but I think we're coiling up before that data tomorrow and Friday, and that data will be what releases markets, okay, in terms of if the data is very different from expectations, I think we'll get a big move, and then actually it'll quieten down, as I said, as we go into next week and people start just wanting to drift away from their desks to go on their holidays. So there you go, ladies and gentlemen. We overran a little bit there. I hope that helped you, Darshan. Okay, we do like to try and help you. Okay, we appreciate the questions and the insight and stuff. That always it's always great. As we said there. Okay, it's just it's great to have you all here. Thank you very much for joining us. I hope you'll join us on Friday for when we talk about price action and gold. Take on board, okay, these points about risk management. The better you get at risk managing, okay, the better your journey will be as a trader. And as always, I wish you the very best of success in your own trading journey. And I'll speak to you soon, traders. Cheers. Take care.